Hello, everyone, and welcome to another episode of the AI Cash Grain Podcast. Today is July 12th. I'm Satish Nandapurkar, Director of Data-Driven Strategies at Quantum Hedging. And in this episode, we're first going to talk about what happened in the corn and soybean markets with Cy Monley. He's going to give us the trader view. Corn resumed its slide, was down 9 cents. Soybeans really fell out of bed this week, down 64 cents for the week. Cy will go through what happened and what he thinks will happen in the next couple of weeks and what the traders are focusing on. Then we're going to go to Kevin, as always, Kevin McNew, and he's going to talk about our models. The corn model actually got less bearish. It's still bearish, but it's less bearish than it was last week. The bean model after the drop actually got a little bit bearish. We were kind of neutral, 50-50 coming into the week, I'll have to say, in full transparency. And then we have gotten a bit more bearish after this drop. This drop has changed some things in the model that's caused us to now be a little bit more bearish. That said, recommendations are still to hold both in corn and beans and wait for more data. I'll go through that in a little bit as to why the recommendations are that way. So with that, let me turn it over to Cy. Cy, take us through what was really a pretty ugly week, especially for beans.
Thanks, Satish. We had a crop report on Friday, and it lowered the old crop and new crop carryout for corn, but just enough to make people, have a short covering 5-6 cent rally there. It's really not enough that I think is going to move the needle to get it in the markets to rip higher or I think get a major short covering rally. The reason is the weather looks perfect moving forward, and the ideas of a 182, 183, 184 corn yield is now on the tip of everyone's mouth. So I think with the forward-looking weather, corn's going to have a really hard time rallying. Now, we have talked about this transition from our large supply to, is there a demand market underneath here somewhere? And we talked about this a month ago with the potential from South American crop as that safrinha crop looked dry. That's been dialed up. And same thing with Russia is, my goodness, their crop looked like it was burning up, but the market sort of kind of calmed down on that. So unless those markets are really small and we do start to see a demand-driven rally, it feels like corn just drifts lower, looking for those demand levels that kind of puts a bottom in. Now, the bean crop, I think, is in the same boat. The weather looks good. Yeah, we got smoke last week, but if you just do a bean to corn ratio, beans look like they got to go down to $10 to find some demand, given how good the weather looks. So I get it. We all talk about how short the funds are, the record short this time of year. Yeah, but the farmer's really long, right? Like the farmer, I know these cash markets were tight and farmers weren't selling, but now that the realization that we're going to have big crops, I think you're going to have to go find out this how strong the farmer is and go to a level down that demand sparks up and the farmer lets go of the grain. So this is going to be a tough 4 to 6 weeks, I think, as the markets just drift lower, finding that demand. Kevin, do our models say anything that's any different?
Hey, thanks, Cy. The way you summed it up from the trader's perspective, I think is really what our models are illustrating in this week's model run. That is, they tend to want to drift lower. And even though beans gave up, 65 cents this week from Friday to Friday, our bean model will show here in a minute is also drifting lower. And so, let's start first with corn. As you said, Cy, the corn market data was somewhat supportive, but mostly, not enough to signal any sort of big changes in our outlook. So our outlook continues to be bearish to maybe slightly neutral. I guess the good news this week is even though the corn market is off on the week, we are seeing our lower end price range start to move up a little bit. So we did see our forecasted end of month prices actually support themselves this week. So, last week we were firmly below $4 on July, end of July, and now we're at 405. But that's still down from where we're at today, so that's not necessarily favorable news. But maybe there is some opportunity here to at least, as Cy mentioned, find some demand that can change the model's view. But right now, the model's view is certainly lower, and I know this below $4 is just a psychological threshold, but also a very economic threshold of pain for our farmers around the country, because $4 on the board is probably going to be some pretty dismal prices for farmers who bought nitrogen either last fall or even early in the spring when fertilizer prices were a lot higher. And so I know that's not going to pencil favorably, but that's kind of where we're at. For beans, again, this week was a painful week with off 30 or off 65 cents from 11.30 to 10.65, and so our models continue to kind of suggest a little bit of downside here as we look ahead. And the bottom end of our range, if we look at the red line, kind of the range of expectations between red and blue, we're clearly in the $9 territory here, in the possibility that markets could drift that low. So, as Cy said, we need to see some demand that will be favorable, but really right now what the model sees that it's pinning its forecast on is really good soil moisture, plenty of soil moisture. We've had big improvements in the last few months that is helping recharge soils, and that's favorable for beans in the second half of the year, when we get into August and if the temperatures do flare up. So that's really, I think, what the model's picking up on, as well as kind of the lack of demand that is something that is needed to kind of shift this price outlook. With that, let me turn it over to Satish.
Thanks, Kevin. And as always, I just want to put this reminder out there that our goal with our recommendations is to beat the benchmark, the typical producer cash sale index, which sells a pre-specified amount at the end of every month. What you're going to see in the recommendations, what you've seen until now, is when our models are bearish and confident enough in the bearishness or the bullishness, they will deviate from the index. When our models do not have a lot of confidence or don't have a lean one way or the other, bearish or bullish, they're not going to deviate much, and they're going to say stick to the index. The index is the best way. Selling a little bit every month is the best way of balancing risk reward. And so we've got this index where it's balanced risk reward by selling, but based on the confidence and the directionality of our forecasts, we might deviate by overselling when we're bearish or underselling when we're bullish. So let's just, again, go back where we are. I had already mentioned we're going to hold both in corn and beans again. With corn, we are oversold 10%. Again, that was from the previous couple of weeks where we've been bearish, and we stay bearish now. And we're confident enough in that bearish view that the simulation models are telling us to stay a little oversold at 50%. And the index is at 40%. So we're a little bit oversold. We have a better average price. The markets are down. So our average price should get even better. So we're tracking to about an 8-cent outperformance versus the benchmark at the end of the program. So we're quite happy with that. With beans, you might wonder, hey, you guys have turned a little bearish. The market just fell. You were even with the index. Now you guys have turned a little bearish. Why are you staying even with the index? It really has to do with how bearish. We're not that bearish yet. And what confidence we have in that forecast. We're not that confident yet. Beans are very hard to predict, much harder than corn, and to forecast out. So last week we were neutral on beans, 50-50, and yet beans had this 65-cent drop. I wish we'd caught that. We didn't catch that in the models. The models are not perfect. They have probabilities where we're reducing the error through the probabilities and we're balancing risk reward. So last week we were even. This week the model's saying to stay even with the index, to stay 40% sold and be patient and see what new data is going to come in. So we maintain that neutral stance. We are tracking to a beat, a 5-cent beat to the index. We'd like to build that up. So as we get more confidence in our forecasts and the directionality of the forecasts as those confidence intervals tighten. Will be going one way or the other, either oversold or undersold, I'm sure, by the end of this month. So, just as a little aside here, I'm going to go through a couple of features of the week. I mentioned soybeans are incredibly hard to predict, and they really are. They're really hard to predict. And I'll show you a couple of the conflicting. It's hard. It's hard to find patterns in the soybean data that are convincing about how we're going to move in the future. Corn's easier. Corn shows a lot of patterns. Corn has very strong seasonality where you can be convinced looking at the data and the patterns about what's going to happen. But soybeans are tough. You get a lot of conflicting stuff. I'm going to show an example. I'm going to do something that's incredibly hard, which is I'm going to take a look at the data on July 12th and just try to predict the rest of the month. What are the patterns that may just predict from July 12th to July 31st? Short-term predictions are really hard. Soybeans are really hard. So we're kind of squaring how hard things are, right? But here's a feature called the Palmer Drought Index. It's an index where if the index is negative, it's really dry. If the index is positive, it's a weather conditions index, a drought conditioned index. And if the index is positive, we're really wet. Sometimes what matters, the patterns we find, is the change in that index over a certain period. In this case, we're going to look at the change for the Palmer Drought Index over the last 3 months. And what we're doing is we're looking at the change so to the right here, things are getting wetter. To the left, things are getting drier. These data points represent the last 28 years. And when things got drier, what happened from July 12th to July 31st? What happened for the rest of July? When things got wetter in those years, what happened for the rest of July? And what we tend to find is this. When things get wetter, when we've had 3 months coming up to July 12th, right, which is like April 12th to July 12th, call it that, when it's gotten wetter over that time, the market continues, beans continue to go down. What's happened is when we're in this range of minus 0.5 or higher, so we've gotten wetter, positive 0.5 or higher, we've gotten wetter, you can see most of the points, beans continue to go down. And right now, we're really wet. Last 3 months, that index has moved to the right a lot. So we've had a lot of wetness in that last 3 months. And when you look at what the points tell you, beans are going down. And that's why I think our models are saying beans are going down. On the other side, when we're drier, beans tend to go up more than they go down, but it's not a lock, right? It's not a lock. You can see there's some points that are down, but the big points are up when we're drier. So there's one thing that's kind of suggesting, given this drought index and the fact that we're a lot wetter over the last 3 months, we'll probably go lower. We've also dropped already, though. Over the last 60 days, we've dropped a lot in beans. We've actually dropped 12% over the last 60 days. And that's not an outlier. We've had years where we've dropped more than 12% from, call it, May 12th to July 12th, kind of 60 days, right? But right now we're at minus 12%. So we've dropped 12% during that period. Do we expect a bounce back, or do we expect things to keep going? Well, if you look at these periods where we've dropped more than 10% over the last 60 days, we have tended to bounce back. That's happened 7 times. We've bounced back 5 of those times. We've kept going down 2. So it's not a perfect indicator. The sort of the bounce back. When you've had such a drastic move down, you get a bounce back. Well, historically, you do get a little bit of a bounce back, but again, not perfect. When you've had kind of a big move up, you do tend to go down for the rest of July. So if we come into July 12th and we've already moved up a lot, we tend to go down a little bit more. But again, not perfect. There are years where we continue to go up, and there are years where we continue to go down. So I just thought I'd throw it out there, why beans are tough and some of the indicators, especially why they're tough in the short term. And I think what our models are telling us is beans are tough. Short term is tough. We've already moved down a lot. Yeah, we're a little bearish, but let's hold and get a little bit more data and see what happens at the end of the month, where the index is going to sell some, and let's see if we should get oversold or be less than oversold when we get to that end of the month. So with that, just a quick summary on the week. Again, corn was down a little bit to 414. Beans completely fell out of bed, dropped 60 plus cents to 1065. Cy talked a bit about how the farmers are still long. Typical farmer is still long a lot of grain, and we're just kind of waiting for demand. His view is we're not going to see any significant pop here until you see significant demand on the soybean side. The worry is that the weather just looks ideal 2 weeks out. So, the traders are looking that this could continue. The models are bearish corn, a little bit less so than last week, but still bearish. They've turned bearish. They were neutral last week. After the drop, they've actually turned a little bit bearish on beans as well. We are recommending in corn, we have a oversold position. We're recommending to hold the oversold position. In beans, we have a neutral position, but again, lack of confidence, enough confidence in the models and the forecast. The simulation is saying to stay with that neutral stance and not get oversold yet. But I do think we'll get there by the end of the month as more data comes in. As always, thanks for being a subscriber. Thank you for listening to the podcast, and we will see you again next week.